Aurodeep, hi, good morning. Thank you so much for making time and speaking with us. Let me start by talking about your report. You recently cut India's GDP forecast for 2023. What are the reasons for the same, and what's this dichotomy about 2022 target being maintained but for 23 being cut?
Right. So for 2022, things look fine, right? So people are going out for to restaurants, going out for vacations. So if you looked at the Q1 calendar year 2022 GDP number, the one sector that was lagging pre-pandemic levels is trade, hotels, transport, communication. Around 6 percentage points below pre-pandemic level. All the other sectors are doing above pre-pandemic level. And so I think what's happening now is this long lost catch up of the services sector that was missing from action for a long time. Plus, you have relatively, the lagged effects of easy financial conditions. The government has focused a lot on capex, and bank credit growth is slowly picking up. So, in the medium term, in the near term, actually the growth looks fine. So we should expect a strong momentum in the next GDP print or so. I guess where we start getting concerned with is 2023, where we've lowered our GDP growth projection from 5.4% to 4.7%. And well, what's driving that primarily is our forecast of a global growth slowdown. So we expect that the US will enter into a recession from Q4 of this calendar year. And that's primarily because you've got the Federal Reserve that's been very aggressive. It's planning to hike rates quite a lot. In fact, our new projection now is that the next rate hike is going to be of as much as 100 basis points. So there's going to be a lot of tightening of financial conditions in the US. As a result of this, not only do we foresee US being in recession, but we also foresee a recession in EU, in South Korea, in Australia, Canada, Japan, UK. So a bunch of economies, especially in the developed markets, are looking at an elevated risk of recession next year. So global growth is likely to slow down. Now, how does this affect India? Well, two ways. One is that there's going to be an inevitable slowdown in exports. In fact, if you look at the last two trade numbers, the merchandise trade numbers, you'll see that export growth has already started slowing down. Plus, investment growth starts to falter at a time when global growth slows down. So the primary driving factor is the fact that global growth is slowing down. But apart from that, I guess it's very important to understand that one, you've got the impact of inflation hitting consumers. So there are people who are complaining that that prices are too high. There's anecdotal evidence of people shifting to cheaper brands, of curtailing down consumption growth. So you've got the pandemic shock to their incomes, plus you have the inflationary shock that's coming in. So you've got consumption growth slowing, and for some reason, we've also not seen private capex pick up after the significantly in the past few quarters. So I guess that's sort of fueling why we are concerned on the medium term growth.
If you would allow me to just interject there, I apologize for that, but because we're also running out of time, I take your point on capex. We've got capacity utilization, including seasonalities now, at more than 74%. But something that our viewers will be watching out for so closely today. We're almost at 80 against the US dollar, the greenback currency. What is that really going to mean at large in the short term? We might be talking about importing inflation, but on the other hand, it's good for forex reserve build-ups. It's good for pharmaceutical companies, IT companies in that sense. And of course, all of this ahead of the US Fed big action next week, the big Q now.
Right. So I think it's important. So there are two factors at play, right, when you're looking at the rupee. One is, of course, what's happening globally, and that's the key driver going forward. But the other thing to take into account is also India's current account deficit. Now, one of the things that we are seeing is that export growth is slowing, but import growth has been very sticky. So we are importing copious amounts of crude oil, of coal, of gold. And what this is doing is that India's merchandise trade deficit it's already hit record high as of June, which beat the record high in May. So what we are seeing is a widening of India's trade deficit. In fact, for FY23, we expect current account deficit to be around 3.3% of GDP. Now, for an economy like India, when you have current account deficit this high, there's obviously concerns on how you're going to fund it. So then people start thinking, hey, portfolio investment is going out, so you've got to rely a lot on FDI and somewhat ECBs. So there is a funding concern that is building up in terms of India's current account. And that's one of the reasons which is sort of driving the weakness too. I don't think that there should be a trade-off between tackling inflation versus external account, because at the end of the day, the extent to which a rupee or any currency, as a matter of fact, reacts, it's not just the global factors, but it's also faith in the domestic macro fundamentals, how stable your inflation framework is, how well your central bank reacts to it, how tethered your fiscal consolidation is. So I guess that those fundamentals shouldn't be compromised. So I still feel that inflation remains elevated. The RBI needs to come and tackle inflation. It's already done a number of rate hikes. We expect it to raise terminal rates to 6% by Feb 2023. So, the inflation fight should happen regardless.
The sense that you get when it comes to our own forex reserves, which have lowered, and with the movement that we're seeing on the currency as well, now sniffing distance from that dreaded 80 to the greenback. How do you expect that this is likely to impact the overall scheme of things? Are you expecting any sort of intervention from the Reserve Bank on the currency?
Well, I mean, the Reserve Bank has already started intervening on the currency explicitly, and also, we had measures announced a week or so back to encourage capital flows in, to ease conditions for people to essentially bring in capital from outside. So all these actions seem to suggest sort of the first or the second lines of defense that typically emerging markets have against a sharp depreciation of the currency. So I guess the RBI is already in the battlefield. You mentioned about the fact that reserves are slowly going down. Well, that indicates the ammunition is being used. On the reserve side, yes, the import cover has gone down. But one of the things that we've observed is that if you take the short-term debt and you take the current account, and you add them up and you see how much of the reserves, how much is this as a proportion of reserves, actually our reserve cover there, it's much better than the situation in 2018 and 2013. So I guess it's important to take into account the fact that yes, reserves, there are pressure on reserves, but we are in a much better off situation than we were in previous times of currency stress. But that apart, I guess that the RBI has said this time and again that we are not in the business of controlling the level, we are in the business of controlling volatility. And in times like these, what one would expect is sort of more measures to invite capital flows in. But I guess as far as the rate hikes is concerned, I think India has an flexible inflation targeting framework, which essentially means that, hey, you should react to inflation and growth and not to the broader factors. You can't target, say, currency using rates. So I think that RBI is likely to remain steadfast to that mandate. So yes, there's going to be rate hikes also, but not necessarily to target the currency, but actually to target inflation.
Fair enough. Thanks much for joining in and sharing with us your outlook on the state of the economy. Just a quick check-in on where we're